$100,000 invested at 7% becomes about $387,000 over 20 years. Put that same $100,000 into a down payment, and the immediate opportunity cost is roughly $287,000 of foregone portfolio growth. That does not mean the house costs you $287,000. The down payment buys equity, reduces the mortgage, avoids private mortgage insurance, and lowers your monthly payment. The house may appreciate, rent may rise, taxes, maintenance, and selling costs arrive from the other direction. So we are going to run the same $100,000 through 3 parallel financial lives. In Life A, you use all $100,000 as a 20% down payment on a $500,000 primary residence. In Life B, you rent a comparable home, invest the entire $100,000 in a broad index fund, and invest any monthly savings created by renting. In Life C, you put $50,000 down, invest the other $50,000, and accept a larger mortgage plus private mortgage insurance. The result is not one winner. Depending on returns and housing costs, these paths finish 20 years with anywhere from roughly $395,000 to more than $1 million of decision-related wealth. The useful answer is not which life wins my spreadsheet. It is which assumptions have to be true for each life to win yours. We need one common playing field. The house costs $500,000. The mortgage is a 30-year fixed loan. I am using 6.5% for the 20% down borrower. That is a planning assumption, not a prediction of your personal quote. Comparable rent begins at $2,700 a month. Rent grows at 3% a year. Property taxes, insurance, and the maintenance reserve also grow at 3%. The index fund earns 5% in the conservative case, 7% in the middle case, and 9% in the optimistic case. The house appreciates at 2%, 3.5%, or 5%. Those are nominal returns. Inflation is still inside the numbers, so future dollars will not buy what current dollars buy. I am also assuming a 5% selling friction at the end. That could be lower or higher depending on commissions, transfer taxes, repairs, concessions, and the market when you sell. The model leaves purchase closing costs outside the $100,000 down payment because they vary so widely. If $100,000 is your entire cash pile, then you do not really have a 20% down payment available. You have a smaller down payment plus closing costs, which moves you toward Life C before the moving truck appears. Now Life A, a $100,000 down payment, leaves a $400,000 mortgage. At 6.5%, principal and interest are about $2,528 a month. Add $5,000 a year for property tax, $2,000 for homeowners insurance, and a $5,000 annual maintenance reserve. Your initial housing cost is about $3,528 a month. That maintenance reserve deserves to be there even when nothing breaks. A roof does not send you a monthly invoice. Neither does an aging heating system. The absence of a bill is not the absence of a cost. It means the cost is waiting in a larger envelope. After 20 years of scheduled mortgage payments, the loan balance is roughly $223,000. You have paid down around $177,000 of principal, but the home's value determines whether that principal reduction becomes a decent return or a consolation prize. At 2% annual appreciation, the home grows from $500,000 to about $743,000. After the assumed selling friction and the remaining mortgage, you leave with approximately $483,000. At 3.5% appreciation, the home reaches almost $995,000. Your net proceeds are about $722,000. At 5% appreciation, the property reaches roughly $1,327,000. Net of selling friction and the mortgage, you have around $1,038,000. That is the ending range for Life A, approximately $483,000 to $1,038,000. Those amounts are not total household net worth. They isolate the wealth connected to this housing choice. Your retirement accounts, salary savings, Social Security, pensions, and anything else remain outside the frame. The initial $100,000 did not compound in a stock account, but it controlled a $500,000 asset. That leverage is the homeowner's engine. A 3.5% increase on $500,000 creates $17,500 of appreciation during the opening year, even though you began with $100,000 of equity. Leverage also works backward. A 10% decline in the house removes $50,000 of value. That is half the original down payment before selling costs enter the room. The home can be a stable place to live, while its equity is highly sensitive to price movements. This is the kind of housing math I care about on Lazy Investor. The monthly payment gets all the attention because that is the figure agents and lenders can place in front of you. Your balance sheet has to live with the entire structure. If you want more boring numbers applied to expensive housing decisions, subscribe to Lazy Investor. Life B begins with no home equity and a fully liquid $100,000 investment portfolio. At 5%, that initial investment becomes around $265,000 after 20 years. At 7%, it becomes about $387,000. At 9%, it becomes approximately $560,000. That is not enough to compare renting with buying, because the monthly cash flows are different. The homeowner begins near $3,528 a month. The renter begins at $2,700. That leaves about $828 a month available to invest during the opening year. I am not giving the renter credit for imaginary discipline. The monthly difference has to enter the portfolio. If it becomes restaurant spending, nicer cars, or a sequence of upgrades that all feel affordable, renting loses one of its strongest financial advantages. The gap does not remain $828. The mortgage, principal, and interest payment stays fixed while rent climbs. Property taxes, insurance, and maintenance also rise, but those costs begin from a smaller base than the rent. By the 20th year, the rent has grown to roughly $4,735 a month. The owner's mortgage payment is still about $2,528, while taxes, insurance, and the maintenance reserve have risen to around $1,750 a month. The homeowner is then spending roughly $4,280. The renter is spending around $450 more each month. Renting created investable cash early, then demanded some of it back later. This reversal matters because early contributions have more time to compound. The $800 invested near the beginning can work for almost 2 decades. The $400 withdrawn near the end has little time left to create damage. Timing changes the value of identical dollars. With every annual housing cost difference invested or withdrawn to maintain equal household cash flow, Life B finishes with approximately $404,000 at a 5% market return. At 7%, it finishes near $578,000. At 9%, it finishes around $821,000. Now compare the middle cases. Life A, with 3.5% home appreciation, ends around $722,000. Life B, with 7% index returns, ends around $578,000. The homeowner leads by approximately $144,000, even though the index fund returned twice the annual percentage rate of the house. That sounds impossible until you remember the asset bases. The renter invested $100,000 plus the changing monthly difference. The homeowner controlled a $500,000 property while paying down debt with a fixed nominal payment. This is the legitimate financial argument for homeownership. It is not that houses always outperform stocks. They do not need to. A moderately appreciating leveraged asset can create more equity than a faster growing portfolio that began at 1/5 the size. The comparison changes rapidly when the rent or appreciation assumption moves. With the middle market return, the house needs to appreciate by approximately 2.7% a year for Life A to match Life B under our other assumptions. Above that rate, buying leads. Below it, renting leads. Hold appreciation at 3.5% and change the comparable rent instead. The break-even opening rent is roughly $2,460 a month. If you can rent the $500,000 house for materially less than that, renting and investing become stronger. If comparable rent is considerably higher, ownership gains ground. Our assumed rent is $2,700. A difference of roughly $240 a month moves the verdict. That is why national buy versus rent declarations are mostly decorative. The same $500,000 property can be an attractive purchase in one rental market and a poor allocation in another. Property taxes can create the same reversal. So can insurance. So can an association fee. A recurring $100 a month invested at 7% for 20 years grows to roughly $52,000. A $400 monthly fee is not a footnote when the alternative is investing that cash for 2 decades. The service received for that fee still counts. If it pays for insurance, maintenance, amenities, or utilities the renter would otherwise purchase, charging the entire amount against ownership would be dishonest. The correct comparison is not fee versus no fee. It is unrecoverable owner cost versus the services and rent the alternative includes. The wide outcome range becomes clearer when the asset classes stop cooperating with our neat labels. If stocks return 9% while the house appreciates at 2%, Life B finishes near $821,000 and Life A near $483,000. Renting leads by roughly $338,000. If stocks return 5% while the house appreciates at 5%, Life A finishes around $1,038,000 while Life B remains near $404,000. Buying leads by more than $630,000. Neither combination requires a miracle. Over a 20-year personal holding period, your local housing market and the stock market can produce very different sequences. The range is the honest answer because 20 years does not transform uncertainty into certainty. It gives uncertainty more time to compound. Life C tries to avoid making the full commitment in either direction. You put $50,000 down, leaving a $450,000 mortgage, and invest the other $50,000. I am assuming a mortgage rate of 6.625%, 1/8 of a percentage point above Life A, plus private mortgage insurance costing 0.6% of the original loan annually. Your actual pricing can be better or worse. Credit score, lender, loan program, property type, and market conditions all matter. The purpose is to measure the economic shape of a smaller down payment, not imitate a loan estimate. Principal and interest rise to roughly $2,881 a month. Private mortgage insurance begins around $225. Add the same property tax, insurance, and maintenance assumptions, and initial housing cost reaches about $4,106 a month. Life C costs roughly $578 more per month than Life A during the opening period. $50,000 remained invested, but you are also reducing the amount available for future investing. Private mortgage insurance is not necessarily permanent. Under the federal rules that apply to many conventional primary residence mortgages, you can generally request cancellation when the balance is scheduled to reach 80% of the home's original value, subject to requirements. Automatic termination generally arrives when the scheduled balance reaches 78%, assuming the loan is current. Appreciation may help you request removal earlier under the loan investor's rules, usually with an appraisal and seasoning requirements. Appreciation is not a cancellation notice. The servicer has to approve the request. Our middle calculation allows roughly 9 years of private mortgage insurance, close to the scheduled path for this loan. If appreciation and the lender's rules let you remove it after 4 years, the outcome improves. After 20 years, the larger mortgage still has a balance near $252,000. That is about $30,000 more debt than Life A. The invested $50,000 grows to about $133,000 at 5%, $193,000 at 7%, or $280,000 at 9%. Yet the extra mortgage payment and private mortgage insurance consume cash that Life A could have invested elsewhere. Under the conservative pairing, Life C finishes near $395,000. Under the middle pairing, it finishes around $645,000. Faster private mortgage insurance removal can lift that result towards $677,000. Under the optimistic pairing, Life C finishes near $981,000. The full down payment finishes ahead of the split strategy in all 3 paired cases. The lead is roughly $50,000 to $90,000, depending on returns and the duration of private mortgage insurance. That outcome should not be surprising. Life C is effectively borrowing an extra $50,000 at a rate above 6%, paying mortgage insurance for the privilege and investing the proceeds in a volatile asset. The investment needs to overcome the mortgage rate, the rate premium, the insurance, taxes on investment returns, and the possibility of bad timing. The split strategy is not automatically a clever diversification play. It is leveraged investing attached to your residence. And yet ending net worth is not the entire decision. This was never merely a contest between a house and an index fund. It is a contest between return, liquidity, and the behavior each structure forces on you. Life A has the highest middle case ending wealth, but the opening $100,000 is trapped in home equity. You cannot use a bedroom wall to cover groceries during unemployment. Accessing equity usually requires selling, refinancing, or qualifying for a home equity loan or line of credit. Those options depend on the property, the lending market, your income, your credit, and the lender's willingness to approve you. A job loss can damage the exact qualification that will let you reach the equity. Life B has a liquid portfolio. Liquidity does not guarantee stability. Imagine losing your job while the market is down 25%. The original $100,000 may temporarily be worth $75,000 before considering contributions. Selling shares pays the rent, but it also converts a market decline into permanent damage. Money that might be needed for a near-term emergency should not be treated as if it can safely earn a long-run stock return. If you keep part of the portfolio in cash or short-term government securities, your liquidity improves while the assumed return falls. Safety has an opportunity cost because every useful option does. Life C begins with $50,000 outside the house. If that amount remains in cash, it can fund roughly a year of the initial housing expense before taxes and other household spending. If it is invested and falls with the market, the runway shrinks. If it is spent on furniture and renovations, the runway disappears while the mortgage remains larger. The split strategy can finish with less wealth and still be the rational choice for someone whose income is concentrated in one employer, one industry, or one spouse. The expected cost of the extra mortgage may function like a premium paid for avoiding a forced home sale. I have had skin in both sides of this trade, surrounded by accountants and tax people who were far less impressed by the word homeowner than by the path the cash actually took. The balance sheet rarely fails because someone chose a house with the wrong countertops. It fails because a household confused equity with accessible reserves. Sequence risk applies to the owner too. Suppose home prices are flat during the opening years and you need to move. A $500,000 sale with 5% friction consumes $25,000 before the mortgage is repaid. The home does not need to decline for your original equity to shrink. Mortgage amortization is slow at 6.5%. During the opening year on the $400,000 loan, most of the payment is interest. You reduce the principal by only a small fraction of the $30,000 sent to the lender. A short holding period therefore combines weak principal reduction with transaction costs. Appreciation can rescue the outcome, but needing appreciation is different from receiving it. The renter has another form of sequence risk. A landlord may not renew the lease. A desired neighborhood can become more expensive. Moving costs arrive without creating an asset. A long retirement spent renting also exposes more of the household budget to future housing inflation. Rent is not free of risk because there is no mortgage. The risks belong to a different category. Price resets, less control over occupancy, and dependence on a portfolio that must continue funding shelter. Inflation gradually favors the fixed-rate borrower in nominal cash flow terms. The mortgage payment remains $2,528 while wages, rents, and prices may rise around it. 20 years later, that payment can feel far smaller even though taxes, insurance, and repairs continue climbing. The renter's full housing payment remains exposed to inflation. Our assumed $2,700 rent becomes more than $4,700 by the final year. That is not a prediction. It demonstrates how a moderate annual increase compounds into a large retirement expense. Inflation also makes every ending number look more impressive than it feels. At 3% annual inflation, $722,000 received 20 years from now has purchasing power closer to $400,000 today. The renter's middle result of $578,000 is worth around $320,000 in current purchasing power. The split result, near $645,000, is worth roughly $357,000 today. The nominal millionaire homeowner in the optimistic case has not necessarily become wealthy enough to spend 1 million current dollars. Part of the number reflects 20 years of the measuring stick getting smaller. Taxes create another set of moving parts, and treating every mortgage interest payment as deductible badly overstates the benefit. Federal mortgage interest generally helps only when you itemize and satisfy the applicable requirements and limits. The relevant comparison is not the entire deduction. It is the additional deduction above what you would have received through the standard deduction and your other itemized expenses. A $20,000 deduction does not save $20,000. It reduces taxable income by $20,000. The tax savings depend on your marginal rate, filing status, other deductions, and current law. Property taxes face their own itemization rules and limits. Private mortgage insurance premiums are not currently deductible under the Internal Revenue Service guidance used for recent returns. Tax law can change repeatedly over a 20-year period, so building the purchase around a permanent tax benefit is optimistic planning. The owner receives another advantage at sale. Under current federal rules, a qualifying primary residence may receive a capital gain exclusion of up to $250,000 for a single filer, or $500,000 for a married couple filing jointly, provided the ownership and use tests are met. That exclusion applies to gain, not sale proceeds, and not equity. Your adjusted basis, qualifying improvements, selling expenses, and previous use of the home affect the calculation. In the middle home appreciation case, the property's gross increase from $500,000 to nearly $995,000 approaches $500,000 before basis adjustments and selling expenses. A qualifying married couple may shelter much or all of that gain under current rules. A single filer could have taxable gain beyond the exclusion. In the optimistic case, the gross appreciation exceeds $800,000. Even the larger exclusion may not shelter everything. The house can create a large tax advantage without turning every dollar of appreciation tax-free. Life B has its own tax range. If the index fund sits in a taxable brokerage account, dividends and realized capital gains can reduce compounding. If some of the investing occurs through tax-advantaged accounts, the result changes again. Contribution limits and withdrawal rules prevent us from pretending the entire strategy fits anywhere we want. The return figures in our model are therefore before your personal tax drag. The home figures do not include a possible capital gains tax at sale because eligibility and basis vary. A tax professional can change the exact ending values, but cannot rescue a bad price-to-rent ratio or an unaffordable monthly obligation. Behavior may create a larger gap than tax optimization. Life A forces principal repayment every month. That can be valuable for someone who would not consistently invest the rental savings. The mortgage converts part of the housing payment into equity without requiring a fresh decision on payday. Forced saving becomes less attractive when the house encourages forced consumption. A larger down payment can make a more expensive property feel prudent. Then come furnishings, landscaping, renovations, and the subtle assumption that every improvement is an investment. A $70,000 kitchen does not automatically add $70,000 to the sale price. It can improve your life enormously. That makes it consumption with a possible recovery value, not a guaranteed capital project. Life B requires active restraint. The renter needs to invest the $100,000, continue investing the early monthly advantage, tolerate market declines, and avoid rating the portfolio for upgrades that home equity would have made harder to access. A spreadsheet renter is perfectly disciplined for 20 years. A human renter sees a liquid account large enough to fund every reasonable desire. The gap between those two renters can exceed the difference between stocks and housing. Life C is vulnerable to both forms of temptation. The mortgage payment is higher, and $50,000 remains visible. If that money becomes a renovation budget, you receive the costs of the smaller down payment without retaining the investment portfolio. This is where psychology becomes allocation. People treat the house as a personality, not a line on the balance sheet. The address begins proving success, the renovation proves permanence, and the larger payment becomes acceptable because the property feels like a responsible purchase. A primary residence can be responsible. It can also be an oversized, concentrated asset, financed with decades of mandatory cash flow. The adjective does not change the debt. Your decision becomes clearer when you stop asking whether buying is generally better and begin testing the breakpoints. Start with a comparable property, not the property you hope to buy against the apartment you are tired of renting. A $500,000 house compared with a smaller rental tells you whether you prefer the house. It does not isolate whether ownership creates more wealth. Then, separate the mortgage payment into principal and interest. Principal builds equity. Interest is a financing cost. Add property tax, insurance, real estate maintenance, association fees, and the annualized cost of buying and selling. Those are the owner's unrecoverable costs. Compare that number with rent, then attach the opportunity cost of the down payment. At 7%, every $50,000 removed from the portfolio gives up roughly $143,000 of potential growth over 20 years. Every $100,000 gives up around $287,000 of growth. That opportunity cost must be weighed against the lower mortgage, avoided private mortgage insurance, reduced interest, appreciation on the house, and the cash flow protection of a fixed rate loan. If comparable rent for our $500,000 property is far below $2,460, the renter has a strong middle case argument. Near that figure, small local details control the result. Well above it, the homeowner's leverage and later cash flow advantage become harder to beat. If you are considering the split strategy, look at it as a loan-funded investment. Ask whether your expected after-tax portfolio return is comfortably above the mortgage rate, the pricing impact, and private mortgage insurance. A narrow expected spread is poor compensation for stock volatility. Then ask what the retained liquidity prevents. If using the full $100,000 leaves you unable to survive a job interruption without credit cards or a forced sale, the mathematically lower return split can be the better wealth decision. Avoiding one financial emergency can matter more than maximizing the average 20-year outcome. If you already have a separate emergency reserve, stable income, and no near-term need for the money, paying 20% down becomes more compelling at a mortgage rate around our assumption. You are receiving a guaranteed reduction in borrowing cost and eliminating private mortgage insurance rather than hoping the retained cash earns enough to overcome both. Your expected holding period matters because selling friction has fewer years to disappear into appreciation. Your local property tax and insurance trajectory matter because they are not fixed. Your tolerance for maintenance matters because a reserve is a financial cost, while an unexpected repair is a financial event. The decision also depends on how much of your existing wealth is already connected to housing. If nearly all your net worth will sit in one address after closing, owning more house may increase concentration even when the buy versus rent spreadsheet looks favorable. A late career household, with retirement 10 years away, has a different risk from a younger buyer with mobile income. The younger buyer may need geographic flexibility. The late career buyer may care more about stabilizing future housing payments and avoiding a large rent obligation after work ends. A retiree with substantial liquid assets may gladly accept a lower expected return to eliminate a mortgage. Another retiree may preserve the mortgage because selling investments would create taxes or because liquidity funds the next decade of spending. Identical houses do not create identical decisions. No spreadsheet can price your preference for control, permanence, schools, pets, renovations, or the ability to remain in one community. Those benefits are real. Problems begin when lifestyle value is entered into the investment column at full price. You can pay more to own because ownership improves your life. You can rent despite a lower projected net worth because flexibility is valuable. Give the preference a name and a budget rather than making the return assumptions perform emotional labor. Subscribe to Lazy Investor if you want housing treated as part of the portfolio rather than a separate universe where arithmetic becomes optional. The house is either a wealth decision or a lifestyle decision, pretending it's both, is how the math breaks. Put a price on the life you want, then make the remaining dollars compete on the balance sheet.